Today we're going to be talking through a number of key slides that I believe should go in your investor pitch deck to ensure that you're bringing all of the relevant information that the average investor is going to want to hear or that they're likely going to be asking you about. This is a deck that can be used for, of course, other use cases, but the concept I'm focused on here is investors given their standard and what they're looking for as far as their criteria for evaluation. So, who am I? My name is Aaron Chavez. I run a local venture studio based here in Miami, Florida. I'm an active founder and mentor, so I'm very involved in the startup community, and I've seen hundreds and hundreds of pitches by this point. And what I wanted to do is share some learnings from the different pitch decks that I've seen and those that have fared well, both for myself and in the programs and places that I spend my time. So that way everyone can build a better pitch deck that hopefully gives them some good outcomes. So here is the punchline. Here is kind of our table of contents. On the left-hand side, you have all of the different topics that typically go in a pitch deck. On the right-hand side, you have basically the punchline of each slide in terms of what is it that we're trying to get out of the slide, what is the point or what is the area that we're trying to cover. So an easy example, number 2, an overview of the problem, right? That's a clear thing that we want to put in a pitch deck. Now, we don't just want to provide an overview of the problem, we want to provide an overview focusing on the pain points the areas that an investor would really care about, such as how real is the problem? Do I believe it actually exists? And 2, how painful is it? Is it a problem that is severe enough that people are interested in solving it, right? So you don't just want to provide facts and figures, you want to provide rationale and logic and an understanding of what this problem really is, how important it is, and why it's worthwhile to fix it. So you can give this a review and see. Here's kind of the brunt of what we're going to be covering, but now let's dive right in. So first up, we have a one-liner summarizing the business. So your one-liner summarizing the business can best be framed as your value proposition. Now, if you are familiar with the item in front of you, you'll recognize the business model canvas, a very common tool used for business planning and business strategy. And right dead in the center, you have your value proposition, which effectively, if you want to make it very formulaic, is what you are, what you do, who you serve, what the result is, and what's different. With those, 5 core points, you really explain and lay, 60, 70% of the foundation of your fundamental business. Do you have secret sauce? Is there this whole narrative of how it connects and why it's meaningful to you? Of course. But fundamentally, your business is, we're a SaaS platform. We help make doctors' offices more efficient. We work with people all across the US. This saves doctors time and makes them more money, unlike our competitors who are much more expensive and don't meet the doctor's needs as much as we do. That's an example of, even in that one sentence, you got to hear basically a full business. Now, of course, there are a ton of mechanical questions on how it works and what it does, but fundamentally, you can say what this business is and you have a concept of what they're trying to do. That is the goal of slide 1, because you can imagine as an investor or a mentor or an advisor, you hear so many pitches all day long that sometimes you just want to keep things simple and you want to make sure that you understand it more than anything else. 2 is an overview of the problem. So like we talked about a little bit earlier, it's not just provide some information on the problem, it's provide specific information that really justifies the reason that we're sitting in the room or having the conversation. So here are 4 points that I typically use to evaluate if a problem is worthwhile and what are the points that the audience are likely going to care about. 1, is it popular or frequent? Popular means everybody has it. Frequent means those that have it very often, right? If you're stubbing your toe every single day, you're going to want to find a way to fix it. If everyone on earth has a demand for X, Y, and Z product, someone's going to want to try and create it. So both can justify in their own way or validate that a problem is likely worth fixing. 2, How is the industry growth? This is the one you're going to get, unfortunately, the least credit for due to the fact that you're not really doing anything about this. You're just kind of on the wave of what's happening. Now, that doesn't make it wrong or bad, but what it means is you need to focus on what's going on in the market, what's going on in the industry, how that impacts what's going on at scale, and just more have an appreciation of it and make sure that if you're on the upward trend of a problem, meaning if it's COVID time and healthcare is growing, you know that healthcare valuations are going to start to go up. You know that a lot of people are going to start approaching VCs to get investment, and you know that there's going to be a lot of people that go, hey, how real is this growth? How much is inflated? What's going on with your problem? Is it over magnified? Is it under magnified? We're trying to really understand the mechanics and the nuance with your specific industry. Next, how costly is it? Cost is everything. It's time, it's enjoyment, meaning if you have a bad time, that's a cost. It's money, right? It's efficiencies, it's retention. All of these things have heavy costs. So make sure you frame it in, every way that you can, but particularly the most expensive way that your audience can relate to. If they care about headcount and you can frame it that way, amazing. If they care about efficiencies and percentages and you can frame it that way, amazing. There are a lot of different ways to, make the same the same point in a couple different ways and have it land with much more impact. And last is it mandatory? Now, mandatory doesn't necessarily mean that the government is mandating it, although it definitely can. But what that means is there even social pressure to do it properly, right? Such as being a consumer or a fashion brand that is very conscious of its environmental impact, right? For a lot of brands, they couldn't just go out and say, we don't care about the environment, we don't care about the turtles. That's not the conversation that is, socially permitted these days. It's much more of a, yes, we're taking our impacts, we're taking our considerations of everything that goes into making our clothing or our products or our goods, and we're trying to find a sustainable way of doing that, right? Which obviously drives a need for sustainable brands and sustainable problems in terms of the solutions that are provided. Next is the solution to the problem. Now, the big thing for this is making sure that your solution directly connects to your problem. That is the number one point on the slide and the number one point that I'm going to emphasize, because so many times founders spend a lot of time setting up a very, nice and well-rounded problem, and the solution that they give, they say, oh, the problem is A, B, and C. And then when they go to the solution slide, all of a sudden they start talking about 1, 2, and 3. It's like, no, everything on your problem slide should connect to your solution side, and they should connect in a way that solves it. Meaning, if the problem is that we are struggling to grow as many apples, per tree, per yield, the solution is a fertilizer, a special apple fertilizer that means we increase the output of every single apple tree in X, Y, and Z way. It directly and clearly and very easily solves the problem in a nice fashion in your head. Next is it the easiest and most rewarding way to solve the problem? Because let's face it, doing anything is difficult. Breaking any habits, good and bad, is difficult. So making sure that you are providing the easiest user experience that you can for whoever's engaging with your solution is really, really critical. Because if you make it too complicated or too cumbersome to use and the problem isn't that bad, it could be that the pain of using your solution isn't worth the solution itself. So you could have something that completely works and is very functional, but nobody goes for it because it's too much of a pain to use. These are the considerations you want to start having early so you know what to focus on as you start doing, the rest of your business. Next is, how are people solving the problem now? It's really hard to innovate when you don't know status quo, because you kind of don't know where you're building from. So if you don't have a full appreciation of what consumers are doing today, it's going to make it very hard to be convincing that you know what the solution is for tomorrow. So having that information available and understanding that, hey, consumers or businesses are doing X, Y, and Z today, but we believe that we should be doing X, Y, and Z tomorrow, or 1, 2, and 3, that change the game, provide all this value, and really bring a lot of, value to the areas that we're looking to, bring value to solve problems for. And last is how financially viable is the solution. It's just the name of the game, especially if you're looking to raise money from financial people that are, of course, looking for a return, investors, angels, VCs, friends and family, whoever it might be. But if you're not building a business that is, financially sound, as far as there is a profit in the future, there is a legitimate business under the hood, it's going to be very hard for whoever it is you're talking to, go all in and really believe in your business. That doesn't mean you have to be profitable day one or even year one or even year two. But if there's never a future of success and profitability, for the average founder, not the 1% founder that's raising billions every third Thursday, but the founder that's just living in the real world with the rest of us, you're going to want to make sure that you inspire a lot of confidence that there's a real business to be built here. It's just going to require a little bit of upfront investment. Next, let's talk about traction. We have a saying at my firm called first name, last name traction, because it's the most important thing about your business. Because if you're proving to me that you have all this movement and interest and demand, and the quick explanation of what traction is, if you want a definition, PPC, proof people care. And proof comes in all forms and fashions, right? If you look at in front of us, it could be digital marketing. It could be letters of intent, meaning non-binding legal agreements that basically say we're interested in working together in X, Y, and Z fashion. It could be that you've got a lot of positive feedback from, dozens or hundreds of customer interviews. It could be that maybe you're already post-revenue. And if you're a post-product startup that's actually going out into the market and looking to grow and acquire customers and do these things, that you are actually able to validate and, of course, show the ultimate proof, which is we have active customers and we're making money from those customers. So clearly there's a hierarchy of proof. Getting a like or getting thousands of likes on Facebook is very different than getting a like or getting $1 or thousands of dollars in your business. So the more traction and the more diversity of traction you can show, the better, because that just is all the proof that people are actually interested in what you're bringing. So as soon as someone understands the problem and as soon as they understand your solution, I want to show them, or I want you to show them, all the traction and validation and interest and demand that you've been able to generate so far, because that hits them really firm. And in the first 4 slides, between the value problem, solution, and this, you're 80% into the conversation. There's, of course, tons more to discuss, legal and finance and go-to-markets and everything else about your business. But you can see how if I'm not convinced or interested in your business by this slide, I'm probably not going to be convinced or interested in it. Next is sizing the market. So of course, okay, you've been generating some traction. That's amazing. Well, how big is this market that you're going after? Now, these are the 3 most common, startup terms when it comes to market sizing: total available market, serviceable available market, and serviceable obtainable market. What this effectively means is the total available market is everybody that you could possibly serve, like on Earth. The serviceable available market is typically everybody that you're looking to serve within targeted geographies, right? It's the actual areas of focus, not just everywhere possible. And then the last is serviceable obtainable market, which is basically where are we genuinely trying to hold ourselves accountable for acquiring customers. So if the serviceable available market's the United States, the serviceable obtainable market, or the SOM, could be Florida and Arizona and New York. Those are our 3 go-to-market states. Those are the 3 states that we're going to be focusing on for the first 6, 12, 18, whatever months it may be. A pro tip here is mature founders, or very savvy founders, don't talk about TAM all day long. They may touch on it, but just throwing big numbers of billions of dollars or trillions of dollars, you can imagine if you're an investor and you hear that hundreds of times, you start to get less excited by it, right? So what investors on average and audiences on average tend to engage more with is actually your SOM. By showing that you have a very focused market, by showing that not only do we focus in healthcare, we focus within behavioral healthcare facilities. Not only do we focus on document processing, we focus on processing insurance documents at scale, X, Y, and Z. You're showing that there's a market of focus, and notice even small markets can be very, very large. Imagine if you got 100% of whatever your SOM is. that's probably millions of dollars a year in revenue. Nothing to shake a stick at. So when you start there and you make that so real and so focused and so tangible, it allows the person who's listening to be very confident that you're focused. You're not trying to, pull out everything at once and all of a sudden, you end up with nothing at all. Now, 3 popular ways of actually doing some of the work besides, Google and whatnot that you want to look at is online market research, which of course includes the Googles and Chat GPTs and Bards of the world, everything that's available online. The golden rule is if it can be found online for free, it should be found online for free. Do not let an investor or someone else know something about your business or your industry that you could easily find on the first page of Google. The better, obviously getting a little bit better, is digital marketing, because that's potentially you running ads, it's you starting a Facebook group, it's you creating a LinkedIn page. It doesn't really matter what it is, but it's the beginning of an audience development, and it's the beginning of a real conversation, and it's the beginning of potentially getting some real validation from people that aren't just the people in your circle. You're opening yourself up to strangers, right? And when strangers like your stuff, when you're getting traction, proof that people care from people that don't know you and don't know you from the man in the moon, so they don't really care if you succeed, that is the ultimate sign of validation, because they have no reason to focus on you. They just want their own problem solved, and that's amazing. And the last but not least, and definitely the best, is customer interviews. One-on-one, individual, in-person, or on-camera customer interviews are by and large the standard. For one, the simple fact that you're building a lead base of potential people, anybody that reacts positively to you doing the interview and seems interested. 2, you're going to learn so much more about the problem than you initially expect, because problems tend to be a lot wider and more nuanced and tricky and interesting than people appreciate, even those that are very well versed. So it's very much customer interviews are kind of a gold mine of lead gen and information and value and all of this stuff. So doing it early and doing it well is a great way to not only allow you to size your market a bit better and understand what their problems are and how expensive they are and what you could do to solve them, but also gives you all of these leads. A big last tip on sizing the market: if you're going to put dollars on the page, also put another unit. Meaning, don't just tell me it's 50 billion in real estate. Tell me it's 100,000 homes. Conceptually, it's much easier for me to think about 100,000 homes than 50 billion in real estate, because I don't know what that means, right? That could be one giant building in my world, I imagine, or that could be a couple small homes that are very nice. Again, there's a lot of questions, and don't make things vague or harder to understand than they need to be. Next is your business model. Now this one is thankfully nice and easy. So the whole goal of your business model is just to make sure they understand how you intend on making money and generating value for the customer overall. And it doesn't have to be fancy, it doesn't have to be complicated, it doesn't have to be that you're charging $1 million every customer. What it has to be is logical, what it has to be is effective. What it probably should be is not based in one revenue stream, meaning even if you just start with one, the idea of having 1, 2, 3 is generally a good idea at a minimum, so that way you can reduce your risk, because one revenue stream could always dry up because of some X factor that you're not predicting, but also because having a few different revenue streams potentially can grow your business a whole lot faster. So you'll see around this circle, there's a lot of the common business models or revenue models that are used in startup land today. So I'd recommend, if you haven't heard of any of these, definitely give them a Google, see which one is the most appropriate for your business. And if you're wondering which is, find competitors, be they direct or indirect competitors, or businesses that are like yours. For example, if you go describe your business as the Uber of mobile phlebotomy, or the Uber of blood draws, or the Uber of that, or the Chipotle of this, or whatever, and your answer is, right? The Travelocity of whatever. What are their business models? And does that business model map onto your startup? Because if it does, and that's how consumers can easily understand your business and value and the relationship of their dollar to the value they receive, that's an amazing thing, and you can lean on their pre-existing knowledge. And then from there, if you want to innovate and change things and do things amazing, by all means. But again, why make things more complicated than you need to? Next is your competition and competitive advantages. So on the left side, you'll see these are the two most common ways that the average startup is going to position themselves as far as how are we in relationship to our competitors. On the top, you'll see what I call the feature battle. We've got features A, B, C, D, E, and F. Companies A, B, C, whoever only have a handful of those features, or their features aren't as good. Or on the far right, after feature B, imagine a column that says cost, and we go, oh, we all have a lot of similar features, but we have all the features at half the cost, right? What you're trying to win is kind of a logic battle of just, we have this, this, and this, they have this, this, and that, and therefore we're better, right? On the bottom, you have what is more commonly referred to as a positional structure, right? A positional battle, which is how are you positioning yourself in the market? For example, if I wanted to describe our business, I would say we're accessible and affordable, right? I put us top right, which is generally speaking where you want to be and how you want to frame it. Bottom left, of course, would be the opposite of accessible and affordable. It would be expensive and inaccessible. So if you're able to frame yourself as we are these two positive characteristics, we exist in this position, in this, situation in the market, and everybody else is, some are accessible, but they're expensive. Some are inaccessible, but they're affordable. We happen to be not only have one of the good characteristics, but both of them, right? This is another way that if you're not trying to compare feature to feature and it's more of like a core business difference or a distinction in offering or a distinction in focus, the positional way of the, x-axis and y-axis can be very helpful. On the right-hand side, you'll see competitive advantages. Now, competitive advantages, the definition gets diluted over time and basically just becomes a little bit softer. But the best way I like to think about it is, what is it that if you were looking at your competitor, you'd be really jealous of them about, right? What is it about their business that is you're hard to imagine, hard to compete with, difficult to engage with, difficult to replicate, right? For example, if you or they have 1 in 10 people that have X, Y, and Z PhD in your type of business, well, there's not that many people on earth that have a competitive, knowledge base. If you have one of the 10 or one of the people that are interested, you have a huge advantage because they can't just go find another one, right? Or you couldn't just go find another one if they had someone like this. So a person or people, specific people, can be very advantageous. The market can be, of course, an advantage depending on not just the fact of what the market is, but how accessible is that market. For example, if you're dealing with very specialized areas within the healthcare field, some of those areas and industries and conferences are only open to people that are in the know and that have the right relationships. If you have people on your team, for example, that have access to these markets because of their pre-existing relationships, that could be a huge competitive advantage. Product is obviously an easy example of competitive advantage. The example I like to use here is if you look at a timeline of smartphones before Apple and after Apple, the release of the original iPhone, you'll see that it goes from every version of Razor, Crazer, and everything in between to black rectangles, right? Because the iPhone was 100x, for the average consumer, let's say, better than the competition. It changed the game. It brought smartphone technology to a new level. It brought touchscreen technology, screen size, all of these different things. It moved it north, 100x. So that distinction was so great for so many people that it obviously was a huge competitive advantage. On top of the fact that they have patents, they have protections, they have things that make it harder to compete with them, right? These are other examples of product competitive advantages. Acquisition. So an acquisition type competitive advantage basically means, can you acquire your customers more easily or more efficiently than other people? So we'll just use an influencer example. Let's say that you're friends with some crazy influencer, right, who just has tons of people and they are very aligned with your product, and your friend will easily pump out content for you and drive a bunch of sales. Now, you can't just go form a relationship with someone like that. Of course, someone you can go buy them and you can go pay them and do these things, but maybe you're a very early stage startup and you're able to generate thousands of interest or lead forms via your friend. And guess what? Your competition isn't able to do that. And that's the advantage that you have that they can't easily replicate, especially with very little money. It could be that you simply have a really good comprehensive understanding of the type of customers that you're going after. Therefore, when everybody else is spending $20 a customer to acquire them, customer acquisition cost, you're spending 10 or 5 or 1. So you're able to your dollar goes so much further. So if I'm in investor mode and I'm looking at you, it's like, well, if I invest with them and they're both the same, this guy can go 20x faster, person B than person A. I'd rather take that risk. And then last but not least, monopoly. There's a great Peter Thiel video where he talks about if someone claims that they're a monopoly, they most likely aren't. I believe it's him, Peter. But if someone claims they're not a monopoly, they most certainly are. So Google and Apple, of course, walk around all day saying we're not monopolies because, of course, they don't want the government to come knocking. But every startup that is, trying to go for their Series B is screaming how they can conquer the world and not a single person can compete and they'll buy every competitor, blah, blah, blah. Well, because, of course, they're too small for it to matter at this point, right? But the best way I think about monopoly as far as conceptually is it's not do you have an actual monopoly, but does it get easier to grow and scale and harder for your competition to compete as you get bigger? For example, let's imagine a streaming service. Well, imagine if Netflix is very small and you had Netflix and HBO next to each other, right? And Netflix and both of them are like year one of business. Well, if Netflix manages to get, for example, like a bunch of Tom Cruise movies or whatever it might be, other studios and other movie production houses are going to see that, and to those that get some comes more. They're suddenly going to start getting momentum and they're going to go, hey, I got the first deal, now that means I'm going to get the second and the fifth and the 10th. As they're scaling, as they're getting interest, it's becoming harder and harder for, in this example, this theoretical example, for HBO to compete because they don't have the momentum, and now Netflix in this scenario has monopoly characteristics at least, which is, hey, we're getting bigger, we're getting more interest than ever, we're starting to be able to charge more because now we've got all this demand, so we are moving in the right direction. We have, these monopoly characteristics. Next is go-to-market strategy. So go-to-market strategy, if you want to break it into a few components, is sales, marketing, and business development. Sales is one-on-one conversion. Marketing is, going out to the world, mass conversion and branding. And business development is partnership formation and utilization. So finding partners, finding opportunities that aren't just converting a singular customer or customers in mass to grow and develop. The easy example would be business A partners with business B to be on their email list and refer each other clients. Easy enough. Now, once you understand which are appropriate, because of course a B2C company that's targeting, millions of consumers probably isn't going to go the one-on-one sales route. And likewise, if you're trying to sell to Apple, you don't really need to run marketing ads at their creative directors. You probably just need to have some relationships to get in the room and have those conversations. So once you determine what's appropriate for you, then it's about understanding, okay, now let me bring it down to my audience. Where are they? Am I one of my own customers? Because the first step is, can I actually find them and engage them to convert them? Because if I don't know where my audience is, it raises a fair question of, are you the right person to solve this problem if you don't know where your audience is in particular? Again, we talked about some of this earlier. Are they already being serviced? How's the problem currently solved? What's the status quo? What's going on in those two areas? Next is there's a big question of, are there community groups, private, public? There's always other people interested in your thing or tangentially interested in what you're talking about. So find those groups and start having conversations, and you can very easily find a lot of access points to your different customers. Next is engaging your customer, because of course, once you actually find them, how do you get them and what are you talking about? Are you using direct sales where you're trying to get one-on-one? Are you doing warm introductions? Are you going the more business development route of partnerships and referrals, or maybe you're white labeling, whatever it might be? If you're presenting this slide to me, I want to know that you can find your customer, that you know how to engage your customer, and then of course, last but not least, that you know how to close and service your customer. Whether it's simply how are you getting the contract signed and making sure that all the revenue is collected, because you'll learn very quickly once your business goes post-revenue, getting the contract signed and getting the invoice sent is the first half of the battle. The rest is actually collecting the money every month, every year, whatever it might be. Servicing, of course, is a big deal because client management, client success, case study development, future product research, a lot of that is predicated on the ongoing service and engagement that happens after you convert a client. So showing that you have a mature process, or at least have an idea and a focus on how you want to continue to develop that customer relationship, is a great way to inspire a lot of confidence when you're speaking about your go-to-market. And last but not least is how are you protecting yourself? You're going to be doing business with a lot of people. You got to make sure you have the right privacy protections, terms of service, the right thoughts around it to ensure that your business overall is being, well guarded. And not every customer is going to be a customer for life. And here's the other truth, not every customer is going to be a good customer. It just means you have to be ready for, all the kinds that are going to come and able to manage it as best you can. Next is team composition. So of course, the earlier you are in your startup, the more that people are going to tend to wonder what is, the value and where is it coming from? And the answer typically at idea stage and seed stage in particular is largely the team, right? Because the team is bringing most of the value, whether it's the thought value, whether it's the information value, whether it's just the work value. So now it's a question of, okay, now we have these people, how do we evaluate these people? There are 3 different ways that I typically am evaluating or see investors and different parties evaluate team members. One is qualifications, right? Are they a known professional in the field? Do they have the degree, the PhD, the whatever it might be, right? Is that their thing? Number 2, are they competent? Now, competent is nice because there's no degree for competence. Competence is all about case studies and track record and proof, meaning like, this is Steve. Steve's like a hippie guy, doesn't even wear shoes, but Steve, I got 3 phone calls from Steve's last 3 clients, and he tripled all their revenue within 6 weeks of being there. We're hiring Steve, and no, I don't even know if he has a last name, because nobody cares. Because why? He's competent. The competence is proof, and it's like, we will pay for that even if the guy didn't go to high school, because clearly he can bring the value that he's looking to bring, and that's what we're hiring. We're hiring value, not pedigree, right? And last but not least is committed. An advisor is different than a mentor, is different than an independent contractor, is different than a junior employee, is different than a co-founder, right? Different levels of involvement imply different things, right? If you have a team of 80 advisors, that tells me that there's a lot of people that are interested in looking at this business, but not whether it's investing or joining the team more full time, there's something missing. If you have 17 co-founders, that tells me that, hey, maybe there's a little bit too much division happening and there needs to be a bit more concentration in who's doing what and how things are being run. But understanding what does the signal or the message of what your team slide says in terms of how many co-founders, how many advisors, who are the mentors, what does the narrative say, and how do you want to present that? Next is your timeline and your milestones. So the distinction between them, timeline is basically the sequence of events. We're doing this, we did this, X, Y, and Z happened, here we are. Milestones are points of note, things where the company kind of had an inflection. It could be that we went post-validation in terms of we validated that our problem was real. It could be that we went post-product, post-revenue. We broke the first 100 customers, the first 100,000 customers, whatever it might be. These are points that are meaningful for your business and that are designed to kind of highlight as little stars for you to speak to when speaking to this slide. Now, I give you an example of kind of the high level left to right of the average startup that goes well. You develop and validate your idea, you go and acquire your team members, you start building, growing, maybe raising some money, you start knocking out all these big goals, and then you plan for the future. The other nice thing to throw on this slide, if you'd like, if you don't want to do kind of what comes next or future development slide, is to put the future developments and planning on this slide on the far right and just show we're aiming for X, Y, and Z, or based off what we've done historically, this is what the future implies. It's a great way to build a little bit of narrative and dialogue into any time you're presenting and pitching. Next is the financial projections. So of course, financial projections are important to the average investor because they want to see that there's a real business here. Now, this can get very, very detailed, but what I want to do is give you some best practices on things that should be included in your financial projections. So one is you want to make it as simple as possible and as complex as necessary. What that means is if you're a fashion company and you deal primarily in leather goods and you don't have a area of your financial model that talks about the price of leather or the different types of leather that you buy or the different volumes, if you just have average handbag $20, that just makes me ask some questions about, do you know enough, and how mature is your understanding of your business, and how are you thinking about the financial implications of market prices changing, et cetera, et cetera. Next is have defendable assumptions. Should go without saying, you don't want to be telling people things that seem questionable unless you have some good proof. And last is know your relevant industry revenue and expense norms. If it's normal in the industry to be growing at 30, 40, 50%, or to have this many clients, or to kind of have this aesthetic, it's an important thing to know. If you know that nobody in the industry spends money on A, B, and C expense, and for some reason you have it in, that either means that you're doing something different intentionally, and that's maybe a good thing, or it could mean that you just haven't done the research and planning enough to understand what should really be in there. Next, let me talk about some of the critical financial questions, meaning if I'm the person that's listening, what's running through my head when you're talking to me about your financials? Now, typically the financial slide is one or two charts that show projected revenue, projected expenses, and projected profit for the first 3 to 5 years of a startup. I would suggest you go for 3 years, and the way that I typically do it is go to an Excel sheet, have 36 months of 36 columns, month 1 through 36, build out your revenues on top, build out your expenses below, net them together, turn that into a chart, summarize each year into 1 year increments. So that way if somebody said, hey, let me take a look at your month to month, you can have that conversation. And if somebody wanted to see your annual or you wanted to put it on the slide, you can very easily summarize those years in a nice way, right? So if that's what goes on the slide and you're speaking to how you made those assumptions and what your goals are, what's going through my head? Well, what I'm asking internally is, what's their growth profile? How many users? How many contracts? How much revenue are they expecting? Next, I'm going, how expensive is it to run their business, both today and as they scale? Is there a ton of variable expense, meaning as they scale more, there's going to be expense that tracks along with it? Or are there more fixed expenses that don't really require as much growth over time, that as we grow revenue, we're going to be able to keep that expense, even if it's not flat, growing much slower than our revenue, therefore our profit's going to increase. Another good sign. Or last but not least, what is the expected capital need to actually support and expand this business? It takes money to grow, unfortunately. Now, if you're a great business and a great business owner and able to generate all the income in the world so that way you can just fund it through the revenue you're generating, by all means, don't even worry about it. That's a great thing. But typically startups, especially in their first 1, 2, potentially 3 years, are looking for outside capital because they're looking to grow, and they're looking to grow much more than they are looking to be profitable. Now, that doesn't mean every startup is going to try and raise billions for the sake of being worth trillions, but what it means is the average startup is going to want some more money so they can go a little bit faster to hit whatever goal it may be, whether it's 10 million, 20 million, 100 million, 100 billion, whatever it might be. Next is capital ask and use of proceeds. So of course, After you talk about the great future of here's all these timelines, here's all these milestones, here's all this great stuff that we're doing, right? We're talking about our financials, we've obviously spoken about our team. Now it's a question of what do we need? Why are we there, right? And the average startup is going to need something, right? And typically the need is going to be capital, and it's going to be an explanation of where that capital is going. So on the left-hand side, you'll see these are typically where you're seeing capital come from in the startup community. At the idea stage and at the co-founder stage, you're going to be getting a lot of self-funding. This is typically where this money is going to come from. It's going to come from you, and it's going to be the kind of initial investment that shows you've got skin in the game. From there, you're going to hit friends and family money. This is where you're going to take some loans, maybe some equity investment, maybe you'll use a SAFE agreement, whatever it might be. Then you're going to hit your seed round, where you'll probably go more angels, friends and family, maybe some venture capital firms, depending on the type of business you are or the type of startup you are. And then beyond that, as you get into your series A, B, C, you're of course going to be hitting angels, angel groups, and of course venture capital firms for sure. Now, once you know kind of who you're targeting and what you're trying to do, it's important to understand what do they care about and what language are you trying to speak to them. So on the right, you'll see an example use of proceeds, walking through 5 big buckets that I typically see the average startup speak to. So one is, of course, sales and marketing. So in this case, the startup's looking to expand their sales and marketing. One is legal. In this case, it looks like the startup is trying to pay for some additional patent expenses. Next is operations, because of course there's always random expenses, whether it's your Google Suite, so you have emails, your Wix, so you have your website, random AWS expenses for different things. There's operating expenses that come up. There's of course general personnel, meaning you've got your CEO, your COO, your CFO, whoever it might be, that are just people. They're the full-time people or the part-time people or the contractor people that are working there. And last but not least is your development area. So in this case, it's your software development. So this startup is looking to do additional feature expansion to their MVP. So this looks to be a pre-seed or early seed stage company that's looking to raise a couple $100,000 or a couple $1 million for around a 12-month runway, and they're looking to allocate it in this way. This is a narrative, this is a story, and you want to make sure that your capital ask in terms of how much you're looking for and the use of it are cohesive. You're not asking for millions of dollars to put it all in operations, because what does that say? You're also not asking for $10,000 to grow your sales and marketing to $1 million, because that doesn't make any sense either. You want to find the balance of what makes sense in the narrative of your business. And that's it. Just like that, you've got a startup pitch deck. So that covers, again, the majority of the information and core points that the average, audience member, investor, mentor, advisor is going to want to see. Your startup, of course, has its own framework and its own focuses and points that are relevant to this. What I would recommend is go through each slide and speak to kind of, if you're doing practicing and whatnot and kind of doing some research on building your deck, what can I do to answer the core questions or make the main 1, 2, 3 points on each of these slides that the audience member is going to care about? How do I make it concise? Then let the points that you're trying to make decide what needs to go on the slide. And you'll find that slides can actually be very simple, very clean, very efficient when you know what you're trying to say.